back in April, I asked a very simple question. What's your ultimate monthly dividend income goal? Now, I expected most people to say maybe a few £100 per month, enough to help with bills or cover the weekly food shop. But surprisingly, nearly half of those who voted chose £2,000 or more every single month. And honestly, I completely understand why. Because whether it's helping with the cost of living, covering your monthly bills, or eventually replacing your salary entirely, there's just something incredibly appealing about money landing in your account while you go about your business. But this raises a very important question. How much money do you actually need invested to earn £2,000 per month in dividends? Is it achievable for normal investors? How long could it realistically take? And what kind of dividend strategy would even get you there? Well, in today's video, we're going to break it all down. We'll look at different dividend investing strategies, realistic dividend yields, and how much capital is required for different income levels. Because the reality is, some dividend goals are far more achievable than people think, and others require a lot more money than most investors realize. So let's get into it. Now, before we start throwing around huge portfolio numbers and dividend targets, let's quickly talk about why so many investors are drawn to dividend investing in the first place. Because on the surface, dividends can actually seem a little bit boring. They're not as exciting as trying to find the next Nvidia. They're not as flashy as crypto. And you're probably not going to double your money overnight investing in dividend stocks. But what dividends do offer is something a lot of investors value even more: consistency. Because when you own dividend-paying companies, those businesses are effectively sharing a portion of their profits with you as a shareholder. So instead of relying purely on stock prices going up, you're actually being paid to hold the investment. And psychologically, that can be incredibly motivating. There's just something satisfying about opening your account and seeing you received £12 in dividends, then 30, then 100, then eventually maybe even thousands per month. It turns investing from numbers on a screen into something tangible. And for many people, dividends also feel more predictable. The stock market might be crashing. Your portfolio might be down 15%. But if your companies continue paying dividends, you're still generating income throughout all of that volatility. Now, of course, dividends are never guaranteed. Companies can reduce them, pause them, or cut them entirely. But historically, many strong dividend-paying businesses have continued rewarding shareholders for decades. And this is where dividend investing starts becoming increasingly interesting. Because depending on your strategy, dividends can be used for completely different goals. For some investors, it's simply about generating a little bit of extra passive income each month. For others, it's about reinvesting those dividends to snowball their portfolio faster through compounding. And for some people, the ultimate goal is reaching a point where their investments generate enough income to partially, or even fully, replace their salary. Which sounds amazing, but as we're about to see, the strategy you choose can massively change how realistic that goal actually is. Now, one thing that surprises a lot of beginner investors is that there isn't just one way to invest for dividends. In fact, there are several completely different strategies, all with different goals, different risks, and very different income expectations. And understanding these strategies is really important, because the path to earning £300 per month in dividends might look completely different from the path to earning £2,500 per month. So let's quickly go through some of the most popular approaches, starting with probably the most popular long-term strategy. And that's dividend growth investing, or DGI. This strategy focuses on companies that consistently increase their dividend payments over time. So instead of chasing the highest yield today, you're investing in businesses that steadily grow both their earnings and their shareholder payouts. Think companies like Coca-Cola, Johnson & Johnson, or in the UK, businesses with long histories of stable dividend growth. Now, the interesting thing about DGI is that the starting yield is often relatively low, maybe only 2 or 3%. But over long periods of time, growing dividends can become incredibly powerful. For example, Imagine a company paying you £100 per year today, but increasing that dividend by 8% every single year. After 10 or 15 years, that income stream can look dramatically different. And this is why many long-term investors love dividend growth investing. It's less about maximizing income immediately and more about building a growing passive income machine over decades. Now, on the opposite end of the spectrum, we have high yield investing. And this is the strategy that attracts a lot of attention online. Because instead of buying companies yielding 2 or 3%, high yield investors might target 7, 8%, sometimes even double-digit yields. And obviously, higher yields mean you need less money invested to generate the same level of income, which sounds fantastic, but there's usually a catch, because extremely high dividend yields can sometimes be a warning sign rather than a benefit. Maybe the company is struggling, maybe the dividend isn't sustainable, or maybe the share price has fallen sharply. This is what investors call a yield trap. The dividend looks amazing, right up until it gets cut. So while high yield investing can generate strong income, it also tends to come with higher risk and requires much more research. Next up is dividend reinvestment, often called DRIPs. And honestly, this is probably one of the most powerful wealth building tools available to long-term investors. Because instead of withdrawing your dividends as cash, you automatically reinvest them back into buying more shares, which then generate even more dividends, which buy even more shares. And this is where compounding really starts to kick in, especially in the early stages of investing. At first, the snowball feels tiny, but over time, it can grow surprisingly quickly. This is why many younger investors focus heavily on reinvesting dividends first, before eventually switching to taking the income later in life. Now, another strategy you may hear about online is the dividend capture strategy, and this one is a bit more controversial. The idea here is that investors buy shares shortly before the dividend EX date, collect the dividend, and then sell the shares afterwards. In theory, it sounds like free money, but in reality, it's usually far less effective than people think, because share prices often adjust after dividends are paid, there are trading fees to consider, and depending on where you live, tax can also become an issue. So while some traders attempt this strategy, most long-term investors tend to avoid it. And finally, probably the simplest option for many investors, dividend-focused ETFs and funds. Instead of picking individual dividend stocks yourself, you can buy funds that already contain dozens or even hundreds of dividend-paying companies. Examples of this include VHYL, IUKD, SCHD in the US, and many others. And this approach offers a few major advantages. You get instant diversification, less company-specific risk, and much less research required. Of course, the downside is that you have less control over the individual holdings. But for many investors, especially beginners, dividend ETFs can be a fantastic starting point. And personally, I think most investors eventually end up using a combination of these strategies rather than just one. Because ultimately, the best dividend strategy depends entirely on your goals. Do you want maximum income today, long-term dividend growth, simplicity, or full salary replacement one day? And with that in mind, let's now look at what different dividend income levels could realistically look like in practice. So what do different income levels actually require? Because earning £300 per month, £1,500 per month, or even £2,500 per month in dividends all sounds amazing on paper. But the amount of money required can vary massively depending on the dividend yield you're targeting. So before we jump into the examples, let's quickly simplify the maths. The basic formula looks like this, which basically means the lower your dividend yield, the more money you need invested, and the higher your yield, the less capital you need. But as we discussed earlier, higher yields often come with higher risk. So throughout these examples, let's use 3 realistic yield assumptions. 3% for more conservative dividend growth investing, 5% for a balanced dividend portfolio, and 7% for higher yield investing. because this gives us a much more realistic picture of what investors may actually experience. So let's start with stage 1, the first level where dividends start feeling genuinely useful. Let's call this the cost of living help at £300 per month. Now, £300 per month might not sound life-changing, but honestly, this is the stage where many investors first become completely hooked on dividend investing. Because £300 per month could cover some groceries, some fuel, council tax, part of your rent or mortgage, or simply just reduce financial stress each month. And psychologically, this is often the first point where investing starts feeling real. So £300 per month works out to £3,600 per year in dividend income. So using our different yield assumptions, at a 3% yield, you would need roughly around £120,000 invested. At a 5% yield, closer to £72,000 invested. And at a 7% yield, around £51,000 invested. Now already you can see how dramatically the required capital changes depending on yield. And this is why some investors prioritize dividend growth while others chase higher income immediately. Now in terms of examples, a UK dividend stock portfolio might focus on companies like banks, energy, or consumer staples. The US dividend portfolio may lean more toward dividend growth companies, and ETFs like VHYL or IUKD can provide diversified exposure across multiple dividend-paying businesses. Of course, your actual dividend yield will fluctuate over time, but hopefully this gives you a rough idea of the scale involved. Now let's move on to stage 2, and this is where things start becoming really interesting. We'll call this stage covering your bills at £1,500 per month. Now this level of dividend income could genuinely change someone's lifestyle. £1,500 per month could potentially cover your rent or mortgage payments, most monthly bills, or allow someone to work part-time rather than full-time. And psychologically, this is often where financial freedom starts to feel possible. Now, £1,500 per month equals £18,000 per year. So using the same yield assumptions, at a 3% yield, you'd need around £600,000 invested. At a 5% yield, roughly £360,000 invested. And at a 7% yield, around £257,000 invested. And this is where many investors suddenly realize two things simultaneously. Firstly, building meaningful dividend income is absolutely achievable. But secondly, it usually requires either a long investing timeline, high savings rates, or strong market returns, or a combination of all three. This is why consistency matters so much in investing, because these portfolio sizes rarely appear overnight. They're usually built slowly through monthly investing, reinvesting dividends, and years of compounding. Now, finally, we arrive at the level that nearly half of you selected in the poll, and that's stage 3, which is the salary replacement at £2,500 plus per month. Now, this is the dream scenario for many dividend investors. A portfolio generating enough income to potentially replace an average UK take-home salary. And while £2,500 per month won't replicate every lifestyle, it could absolutely provide flexibility, reduced working hours, earlier retirement, or the freedom to focus on things you genuinely enjoy. Now, £2,500 per month equals £30,000 per year in dividend income. So here's what that could realistically require. At a 3% yield, around £1 million invested. At a 5% yield, roughly £600,000 invested. And at a 7% yield, around £430,000 invested. And honestly, this is where dividend investing becomes a balancing act. Because yes, higher yields reduce the capital required, but they also increase risk, volatility, and the chance of dividend cuts. Which is why many long-term investors eventually prioritize sustainability over simply chasing the highest possible yield. And personally, I think this section highlights something really important. You do not need to immediately aim for £2,500 per month. even smaller dividend milestones can have a meaningful impact on your life. Because whether your portfolio pays £30, £300, or £2,500 per month, every dividend payment is still another step toward financial independence. Now, before everyone rushes off to search for the highest yield dividend stock they can possibly find, I think it's important we have a quick reality check, because dividend investing can be an incredible strategy, but it's definitely not a guaranteed path to easy passive income. And honestly, I think this is where a lot of finance content online can become a little misleading. Because you'll often see headlines like "earn £5,000 per month from dividends," but what people don't always mention is the level of capital, risk, and time usually required to get there. And there are a few important things investors need to keep in mind. First, dividends are not guaranteed. Even some very large companies can reduce or completely cut their dividend payments. We saw this during COVID, economic downturns, and periods of high interest rates. A company might be paying a fantastic yield today, but if profits fall or debt becomes a problem, that dividend can disappear surprisingly quickly, which is why chasing the absolute highest yield available can sometimes backfire badly. If a stock is yielding 10, 12%, or even more, there's usually a reason investors are demanding that higher return. Sometimes it works out, but sometimes it's a warning sign rather than an opportunity. This is what investors mean when they talk about yield traps. Now, another thing people often forget is inflation, because earning £2,500 per month sounds fantastic today, but in 10 or 20 years' time, that same amount of money may not have the same purchasing power, which is exactly why many dividend investors prefer companies that grow their dividends over time rather than simply paying the highest yield today. Then there's tax. Now, here in the UK, accounts like the ISA are incredibly powerful because dividends can grow tax-free inside them. But outside tax-advantaged accounts, dividend income can become taxable depending on your circumstances. So the actual income you keep may be lower than the headline numbers we discussed earlier. And finally, probably the biggest reality check of all, building large dividend income streams usually takes time. For most people, this isn't something that happens in 6 months or even a couple of years. It often is the result of consistent investing, reinvesting dividends, increasing income over time, and staying invested through market ups and downs, which admittedly sounds far less exciting than "this one stock will make you rich." But personally, I think there's something incredibly powerful about slow, consistent progress. Because every month you invest, every dividend payment you reinvest, and every market dip you continue investing through, you're gradually building an income-producing asset base that future you may one day be extremely grateful for. And honestly, that's one of the reasons I enjoy dividend investing so much. Not because it's a shortcut to wealth, but because it rewards patience, consistency, and long-term thinking. And so there we have it. Whether your goal is an extra £300 per month to help with the cost of living, £1,500 per month to cover your bills, or eventually replacing your salary entirely with dividend income, hopefully this video has shown you two things. First, building meaningful dividend income is possible. But second, it usually takes far more patience, consistency, and capital than most people initially expect. And honestly, I don't think that should discourage anyone. Because the most important part of dividend investing isn't necessarily the final number. It's building the habit of consistently investing in the first place. Because every share you buy, every dividend you reinvest, and every month you stay invested moves you one step closer toward financial independence. Now, I genuinely love to know your thoughts in the comments below. What is your ultimate monthly dividend income goal? Are you aiming for £300 per month? £1,500, £2,500, or something even bigger or even smaller? And if you enjoyed this video and want to learn more about dividend investing, make sure you check out this video right here, where I asked investors, AI, and real market data, what is the best UK dividend stock? Or if you'd prefer to follow my own investing journey in real time, you can watch my monthly portfolio update series, where I share my dividend income, portfolio growth, and exactly what I'm investing in each month. If you did enjoy the video, leaving a like really helps the channel out. And if you'd like to follow the journey toward long-term passive income investing, feel free to subscribe. Thanks for all your watching. I'll see you in the next one. And as always, keep it simple, keep it realistic, and keep it effortless.